Good morning. Welcome to Market Sundays. We are live. Hope everybody's doing well. Hope everybody's got their sleep in. It's going to be a pretty good Sunday, I'm expecting. I got some things to do today, so I have to make sure the show gets rocking out early on. So thank y'all for pulling up. Thank y'all for tuning in. The American Negroes here. What up, family? So as we are edging closer to the end of the year, we have one more meeting with the Fed, and I think that's coming next week. I don't expect any dramatic changes, any impulsive decisions that can spook. I expect more like a passive or a very, I don't, the word's not passive, a more cautious process than anything, meaning that I think the Fed is going to be, no, the word I'm looking for is conservative. I'm expecting a conservative response from the Fed because they don't want to spook or shift the markets too much as we go to the end of the year. And we have an incoming new leadership team to run the country. So that's what I expect next week. Nothing crazy from the Feds. We got 2 weeks left in this month, Q4. And towards the end of the year, we always see a lot of shifting. We always see some things going on, okay? So that's what I want to get into. I want to talk a little bit. Well, this show is going to be definitely focused around BNPL, buy now, pay laters, because I'm watching some shifting going on. I want to talk. I have this strategist from Charles Schwab, and he's talking a little bit about the end of the year movement. And I want to briefly get into some diamonds. Diamonds are forever. Some talk around what's going on with the industry there, just because, we like diamonds in our culture. We love diamonds. We like to shine. We like to stunt. And so it's always interesting to see where have we shifted or moved when it comes to the diamonds industry. Because I don't even think we like to buy those regular gold ropes no more. I mean, Nip had some. You had a few. You got Hove that got, but you don't really see that as much. You see that ice. And they say diamonds are forever. So I won't take up too much of y'all time. I know it's Sunday. I know it's game day. It's some big games on today. I want to make sure you guys are able to enjoy that. But I'm trying to do my best to be as consistent as I can on these Sundays because it is hard. Life will beat you up. Life will beat you up as you're trying to get, stay consistent, do everything you need to do. Life is pulling you one way. Life is pulling you the next way. So I'm just trying to stay focused on that and around my consistency. All right. So that's my goal. All the support, all the help, all the comments, all the chats, all of that. It really, really goes a long way to keep pushing this conversation for me. I want people to be able to go back to the shows, have a calm intake, meaning when they see the show, it's lucid. It's easy for them to understand. It's not too complex. I'm breaking it down to a very simplistic but actionable things and plausible things that you can do currently right now in society, and just giving you my perspective of what I see. And we use our own life experience to kind of make decisions and our skill sets, right? So I will always push for you guys to increase your skill set, increase your reading, stop being lazy, get out there, read, learn, push yourselves. Take risks that you're comfortable taking. Take risks that you might be uncomfortable taking. That's the only way that your life is going to shift. Your life will not change if you continue to think the same way and continue to do the same things. The change only happens when you do something differently and when you start thinking differently. So get around people that don't think like you. Broaden your mindset a little bit. That doesn't mean you can't do the things you like. I know you like anime. Okay, my brother G-Ville's in the building. All right, so send some love to start the show. I know y'all like y'all anime. I like Pokemon. I'm supposed to be playing the game, but I've been heavily distracted by the world. And I really honestly just want to sit back and sit in a quiet room and just relax. But life is not giving me that opportunity right now. So what life is giving me now is the ability to use my skill sets for whatever they are, maximize them, and run away with it. So that's what I'm here. Shout out to my brother G-Ville for sponsoring the show. I thought he was asleep. I ain't gonna lie, I did. I was like, you know what? He should be asleep right now. But for some reason, he has an addiction of staying up all night. And we appreciate him over here. All right. First thing we're gonna get into is these diamonds. The first thing we're gonna get into is these diamonds. Gang. Because I want to know if it's true, if all your favorite rappers are buying up all the diamonds. I'm also looking for Miss Lauren Mack. Okay, somebody put that APB out for Miss Lauren Mack. I cannot find her. She is nowhere to be found. So one of y'all track her down. Okay, she must be found. All right. Atticus, what's going on, brother? Let's get into it. We're gonna start with the diamonds. Okay. There's been a. Oh no, let me shift up here. I kind of like being. Yeah, I got big hair, so I think I like it better that way. So when it comes to these diamonds, they are saying that these lab diamonds are making a huge disruption on the industry. Now, I don't own a lot of diamonds. As a matter of fact, I don't have any diamonds. So you're not about to get me in trouble. I stay away from these YouTubers sometimes, man. But y'all know which guys y'all need to stop listening to. I ain't gonna say no names, but lab diamonds is disrupting the industry once again. Okay, and I'm wondering just how far the shift has come as far as consumers, how we view lab diamonds, or is our preference still the same? Since we can't physically tell the difference.
They're chemically, physically, optically identical.
What about with one of those loops that they wear?
Under a 30X, under a 10X, you could not tell the difference. The only way you could is there's specific testing equipment. So either you send it to the GIA, IGI, or in a jewelry store, they do have testing equipment that can tell the difference. But very small nuances. So for example, one is nitrogen-free, which is lab grown, and the other has some trace elements of nitrogen. But to the naked eye, you can...
These not the diamonds that T Grizzly went down for. This not when he was out in Kentucky and all that, and he was trying to come up off these diamonds. That's not them. That's not the same diamonds. See, these diamonds were made in the lab. But I'm gonna be honest with you, they look the same to me. Shine the same. Do I really care about the difference between lab grown or ones that are made from the earth? I don't know if I care so much, but them lab diamonds is perfect.
Cannot tell the difference.
Can we talk about the quality scale though, and if it exists? Because this is mean, but there's Facebook groups that are dedicated to calling out like poorly made lab grown diamonds. Moissanite, for example. I feel like you can tell with certain diamonds.
Yeah, so moissanite is not.
No, you cannot tell. You know how I know you can't tell? Because fellas keep putting on the fake jewels and we keep getting them. Girls can't tell if they fake, y'all, so don't listen to her, all right? The fellas know what I'm talking about, okay? Y'all see some guy walking down the street. Lee ain't here, but down somewhere in Miami, iced out and everything. The girls, they don't know if it's legit. They scared. They like, man, I don't want him to think I'm a gold digger, but them diamonds make me think he getting money. So I can't tell if they real or not. So, and by the time she figured out if they real or not, you're in and out like a thief in the night. You already done touchdown. Then she wake up. Oh, so we going out to dinner? I'm out. Shoo. So look, they can't tell. So don't let this lady trick you. Unless they walking around with a 10X magnifying glass, they don't know if them diamonds, or if they got them diamond testers. Ooh, yeah. If they got them diamond testers, get out the way. Get out the way. So yeah, no, they can't tell at all. And so it's some battle rappers that got some jewelry that is as they say on the podcast, fugazi. Okay, they got some jewelry that's not legit, and a lot of people couldn't tell. They even try to snatch them, and they found out they wasn't legit, and they was very upset. Okay, so they can't tell
A diamond, and you can certainly tell.
Yeah.
With the trained eye. But with the lab-grown diamonds, are chemically, physically, optically identical, so there's actually no fundamental difference. And they're cut and polished by hand the same way a natural diamond is. So they look identical.
So what are you selling? Are you selling the real deal? Are you selling lab grown? Do you have a mix?
We're selling both. We launched lab grown 15 months ago. So on the same product page, we'll offer the same design in both lab grown and natural.
What's the price difference? Say a 2 carat,
10x. For the actual diamond part of it, 10x. Yeah. So a 3 carat engagement ring, for example, would be $30,000 if it's natural.
Woo! We in the wrong business. We in the wrong business. Did he say 10? Did he say a 3 carat diamond engagement ring that is natural? He wants 30 racks. So 3 carat, that's 10 racks a carat. Yo, I see why T Grizzly was doing this thing. At first, I was like, Grizzly, you tripping. Now I see why he had to get that money. See, I be judging people from afar, but I've learned my lesson not to be too judgmental, okay? Because if I can get me 10 racks a carat, Bugs Bunny gonna have a new homie. What's up, Doc? Bugs Bunny gonna have a new homie. 10 racks. Man, oh man. I can't wait till we get some ownership in this industry. All right. When we start owning our own diamonds. Man, oh man.
It'd be $3,000 if it's lab.
That's fascinating.
Whoa. I heard him say 10x, but it hit different. It hit different when he say the difference between $30,000 and $3,000. It hit different. So would I rather lab diamonds that chemically, scientifically are an exact match to a natural diamond? Do I want to pay $30,000 or $3,000? Is this a real question? Can I ask y'all something? Have we moved on? Have we grown? Have we matured to where we no longer let them get us what it's real, those ain't legit? We always used to rag on each other. Y'all remember the fake J's, right? When the Jumpman was backwards? Yeah. I don't think I had those, man. I had the Pokemons. I refused to wear the fake ones back then. I would just stick with my Payless shoes, all right? So I ain't one of those ones, but our culture is very big on authentic ones, So I think it's time we grow up. If you telling me to the untrained eye and scientifically the difference between our egos is $27,000, and then you extrapolate that $27,000 times 2, $27,000 times 3, $27,000 times 10. Man, we looking at $300,000 differences, all because of our ego or branding at best. I think it's time we mature a little bit. And I think a lot of rappers are probably wearing these lab diamonds because I'm going to be honest with you. How is it possible that they control the diamond industry by limiting the supply? That means behind the vaults, the Bears company, that huge one. And they always control the market that way. How is it possible that these rappers keep getting new ice, keep getting new diamonds, where are they getting all these diamonds from? They have to be lab made. It's really, really hard to find all these earth-grown diamonds at the rate in which we producing rappers and jewelry. Would y'all agree? Don't y'all think it's almost impossible? If y'all go through every single rapper we've seen and how limited diamonds are based upon the control of the market and them only releasing a certain amount every year, every quarter, etc., it's not possible. It's not possible for these rappers to be having the real authentic Jones. They got to be having the lab diamonds. I really believe they got the lab diamonds.
See those prices converging, though, because I think about other luxury items. And I hear what you're saying, the research out there that it's much cheaper to produce these lab grown diamonds. But you think about, luxury handbags, for example, they don't have that high markup because they were expensive to make necessarily. It's just because people want it and there's a ton of demand and there's this mystique about it. So do you see that happening with lab-grown diamonds as well?
I think on the lab-grown side, the prices have stabilized. So 2018, they were roughly 15% cheaper than the natural equivalent. Now they're 90% cheaper. They're not going to get cheaper from here, most likely. Diamond prices, however, natural diamond prices have been coming down dramatically.
Yeah.
So versus peak, they're down 50%. In the last 12 months, they're down 23%. Pretty amazing. And as you mentioned at the beginning, De Beers dropping prices by 10%. They're still high. So a site holder, which is a direct customer of De Beers, who's buying that parcel of rough, is still losing money. So there needs to be another 15 to 20% correction before the market starts stable.
Wow. Wow. So to simplify all that, it seems that the demand for, like, I guess they call them homegrown, like, I don't know what they call them. Do they say homegrown diamonds? I forgot what he said, but essentially non-lab created diamonds, the cost for them have been dropping 50% from their high, 22% over the year, which is telling, which means that people are probably not coveting the wanting to pay more for something that looked the same. Like, I'm sorry, was it Chad Ochocinco that said, if Bill Gates put on a fake rollie, would you care? And would you care if someone had said it was a fake? Like, it's really, you wouldn't even know, but it's really interesting. So I don't think I'm willing to pay a premium price just to say my diamond was found in the earth, as opposed to it being created in a lab. And scientifically, it is pretty much identical. Yeah, something about that makes me realize that we really messing up with our money. We messing this up a lot. So, but the fact that we see that the cost for these diamonds are going down, it means something. It means something. So that maybe we learning, maybe we adjusting.
Stabilizing, so we're going to continue to see that.
I mean, I imagine the only reason you'd want a real diamond versus a lab-grown diamond is for the value of it. Since you can't see the difference, you can't tell, you won't know, right?
Yeah.
I guess the only reason that you would want a real diamond is to hold the value, but as it drops, that reason becomes
moot. Yeah. I mean, historically, there's two reasons people bought natural diamonds. One is this inflation hedge because it starts appreciating over time. And two, there's financial flex. So if you're wearing a 2-carat or 3-carat ring, it's showing, it's telling you something about yourself.
I never knew that. I never knew diamonds was used as an inflationary tool. Have you guys ever heard that? I never knew that they use diamonds to combat inflation, because the natural diamonds, they go up in value over time. I never knew that. I never even heard it positioned that way. So now maybe that makes sense, but I've never heard it presented that way. This guy's the expert, though. I'll concede to him. But using diamonds, haven't y'all always been told what I've been told, which is diamonds don't maintain their value. They typically go down in value. So to him say inflation, I mean, I guess those are two different things, value versus inflation, but still, that is extremely interesting to me. Guys, we might have to, in order to combat inflation, we might have to get to these natural diamonds, y'all. They always say diamonds are forever.
With lab-grown being 90% cheaper, the financial flex goes away. With diamonds going down in price, the investment thesis goes away.
And there's not a market, as with gold and silver or copper, right? These are traded and we have spot prices in different markets. You don't have the same thing with diamonds.
You can easily resell it, but not nearly as easily as gold. Yeah. Correct. Yeah.
I do want to move on from diamonds because I'm looking through your notes. You also talk about colored gemstone engagement rings, which, in the nasty Facebook groups I'm a part of, they get a lot of heat as well.
But they don't like emeralds or sapphires?
No.
They don't like rubies?
No.
In engagement rings?
No.
What Facebook group is this?
I don't know. It's this
okay, guys, I think we have learned something new. We have learned something new. These homegrown diamonds, or natural diamonds as they call them, have been used as a hedge for inflation. So now we can take that knowledge and see if that's something we can add to our arsenal too. Because I got to really look really far into that, because I've never heard it positioned that way. But I've always heard that it's better to buy the natural ones than the lab ones. And he talking about 10%, 10x markup. So it's very interesting. That is very interesting. All right. So that's what we learned about diamonds on Sunday. Okay. So if you guys want to buy somebody a diamond, me personally, I'm using rhinestones. So if you have interest in me, you're getting a rhinestone. I don't want to hear nothing about I want the real deal. No, you got Michael Kors. I don't want to hear nothing. You wear Michael Kors, you get rhinestones. Okay, I'm not about to play this game with you. They already marking the price up 10 times on me. No, rhinestones it is, my friend. Okay, if you're lucky, you get a sapphire. Okay, because sapphire is kind of cool. If not, stick with them rhinestones. Okay, now let's get into this Charles Schwab analyst. Seeing that some with those crystals. So seeing as we get towards the end of the year, right? I want to continue to follow the behaviors, the consumers, and I want to see what people are doing, so that way we have understanding of the flow of the market and future behaviors, right? So that's what's going on. Tom said, what's wrong with gems? Nothing. But you getting rhinestones. What's wrong with gems, Tom, is the cost. That's what's wrong with them. You want me to pay $30,000 for 3 carats when I can pay $3,000 for lab grown and pocket me $27,000? I don't even know if this is a conversation anymore at this point. I'm gonna be perfectly honest with you. I don't even know if this is a conversation anymore at this point. I'm definitely getting the lab diamonds. I think I've convinced y'all to get the lab diamonds, okay? Now, you guys tell me, are you guys going to go with the lab diamonds, or are you guys going to go with the natural diamonds, okay? Which ones you guys going with? I'm going with rhinestones, but if I had to be forced into it, I'm going with the lab diamonds. So when y'all see me, all right, if y'all see me out and y'all see me shining and y'all see me diamond all up, just know they lab. So leave me alone. You're not about to get much on the resale market. These ain't natural. These ain't the natural diamonds. Leave me alone. I'm just trying to get my shine on, trying to make, and I'm going to go out on a hot summer day, by the way. I ain't going to get icy in the winter. Nah, because I don't have the diamonds that glow in the dark like those rappers do. No, I don't have those, what they call those VVSs and all that. No, I ain't got those, okay? I got these lab-grown ones, and I'm going out at summertime when it's 100 degrees. That way that sun bling, bling. When you see me, every time you see me in your city, bling, bling. So that's the only way I'm doing it, okay? And I'm protecting myself because then I'm hedging against the cost of natural diamonds versus lab diamonds. See? Financial decisions, guys, okay? Now, let's get into the end of the year, right? What are we seeing? What are some of the experts seeing now? Joe Mazzola is an analyst from Charles Schwab, okay? Charles Schwab is a huge, mega financial institution, okay? They control over $7 trillion of assets under management, okay? So you're thinking about big time clients, the uber rich, the billionaires, the 100 millionaires, not sometimes even the 100,000aires, even though we made that up. And they actually have your retirement accounts. And I say that because they have a host of access to data and to what people are doing in these markets, as far as watching how the end of the year, how people are setting up their portfolios and things like that. So the reason and the advantages of all these huge companies is data, clientele, scale, information. And so that's why we listen to what these experts are saying, because they have access to a whole pool of things that we do not. So we wouldn't naturally be able to get this information on our own, because we don't have one of these companies that have these X amount of customers. And when you're talking $7 trillion of assets, that is insane. That is insane. So they are a behemoth when it comes to the financial markets, their influence, their impact. They've been around for an extremely, extremely long time, and they've always been a friend to the uber wealthy. Okay. So let's get into this analyst and he's going to tell us what he sees going on towards the end of the year as people are shifting, adjusting their portfolios as we go into the new year.
Charles Schwab just out with a new trader sentiment survey to gauge investor behavior into year end and beyond. Let's bring in Charles Schwab trading and derivative strategist Joe Mazzola. Joe, happy Friday. So
hey,
the election had a big impact on sentiment, but some people were selling, at least mega caps, into that. What happened?
Yeah, no, I think that's a good way to look at it. I think the bump that we saw post-election really gave client sentiment, at least that's what they're telling us, gave a little move to the upside. We saw the rotation away from maybe some of the high beta names into maybe a little bit more cyclical names. Interesting to see, though, that the sectors that were bought were healthcare, not something you normally expect, kind of following that move. But IT continues to be a big buy in terms of some of the names in particular. NVIDIA, Palantir, AMD. So, you did see the AI related names, but I think interesting on the sell side were some of the names that had nice moves up to the election, and then of course big moves after the election. Apple, Disney, and Tesla. So here you go. You continue to see Tesla set all-time highs, and it looks like that was something that clients faded a little bit.
To what extent do you see clients chasing momentum?
Yeah, that's it. That's interesting because this is one of those what are they saying versus what are they doing kind of things. They're telling us they're really, really bullish from a sentiment standpoint. So we actually asked them attitudinal versus behavioral, and we're hearing from them that they're about as bullish as they've been in many years. But the rotation that we're seeing, John, is a rotation away from kind of the single stock idiosyncratic risk, a little bit more into the ETFs and mutual fund space. So clients are kind of moving away from stock picking and moving a little bit more into the indexing and looking for ETFs as a whole.
So what that tells me is this. People have seen their portfolios increase, right? So I don't know if you guys been watching your portfolios, even if you just close your eyes and threw a dart at something, most people's portfolios have been performing pretty well. Okay, if you're looking at all of the mega companies, they've been doing decently well, etc. So what he's saying is that they have been seeing such a run up that there seems to be a little bit of apprehension going into the next year that they are taking away that individual stock risk, right? So this has been the last few years of this bull run. Individual selections of stocks have been high priority for people. But there seems to be some fear going on, and now you're starting to see a rotation from single stocks to safer bets like ETFs, where you start to spread the risk out. And so the downside is not as great, and the upside is not as great as single stocks would be. So if you're in a single stock, the downside risk that you would take is insane. Okay. If a report comes out, like we saw with what was it, Supermicro? Which company was it? What they had the whole accounting firm issue. That thing dropped like 50%, just like that. And so with ETFs, you spread the risk, and you would not have that much money isolated and concentrated into one company, and you wouldn't be down 50%. You might get hit 5% or something like that when you spread the risk out. And so what he's saying is there's a huge shift from that type of risk to now going into ETFs, right? Which I think I always thought it was best to do both. So you have ETFs, you have indexes, and then you have to deal with, because you cannot, the upside of a single stock is just insane. Like what you can make in a single company versus being in an ETF is night and day. But the downside is as real as it gets.
Okay, on saying versus doing, they're telling you that they're not buying more crypto, but is that true?
That's a great point. If you look at our top 10 buy list for the month of November, IBIT and MicroStrategy were both on that list. So yeah, and maybe it's looking at it in terms of the way the question was asked, right? Maybe they're not actually buying the spot Bitcoin, but they are looking for some of the different kind of plays as a way to have that exposure. And John, I would just kind of call out the volumes that you're seeing, not only at the underlying level, but look at the volume explosion and the options for both of those names, MicroStrategy, IBIT, in all of those ETFs. You're really starting to see some heavy trading within those option series.
Is crypto maybe a guilty pleasure? Have you seen enough data in the survey versus what people are doing to be able to say one way or the other? I mean, people feel like they're supposed to say that they don't love it, but they can't help but snap up a little more MicroStrategy.
I think that there's a couple stocks that we consider mega caps that might be falling under that whole meme stock right now, and I think you could make a case that. To a certain extent, some of the crypto ETFs are falling into that category where you're starting to see clients trade it because they see that there's opportunity, to get in and out and make some money. And that's fine. I mean, we have an investing population, we have a trading population, but the activity that I see within that, makes me look more so that, these are trades as opposed to underlying positions that people are taking for the long run.
Are clients trying to time the market in mega caps?
Always.
That's interesting. What I would say is that clients are being selective in what they're buying. So as opposed to, and I brought this up earlier when I talked about the net sell. So it wasn't necessarily buying all the Mag 7. I mean, they were fairly selective, selling Apple, selling Tesla, and so that's not just buying across the board. What I think they're looking for is they're buying on dips when they get the opportunity, and they're selling on rips. And like I said, if you look at what we saw with Apple and Tesla, those are both stocks that set all-time highs at the end of November into December. So we'll see with some of that momentum wanes. What I would call out is this, John, the breadth that we're seeing is really starting to dissipate a bit. So it's becoming a much more concentrated rally within a few names. And I don't know how long that can sustain, but there's a chance that carries forward through at least the
Man, oh man. So that gives us a little insight on what Charles Schwab, and the reason we select him is because they got $7 trillion in assets under management, which means they have a lot of say-so and a lot of knowledge on what the majority of our country is doing. You know what? I'm going to actually talk about what I see, what I've seen personally around this type of time. Sway, what up? Hey, Sherelle. Said I need $5, so I can put $5 in because I'm from $5 won't work, sir. I'm telling you now. I'm not one of those people that will tell you to get the little app, the Acorns app, and then go buy something at the store, and then check your 50 cents and then go to $1. I wouldn't tell you that. No. I tell people very, very simple. Concentration. Well, accumulation, concentration, diversification. So you're going to have to increase the snowball. You're going to have to increase, my friend. If you need to sell burgers and fries in order to make a few extra bucks, that's what you got to do, my friend. I'm sorry. If you need to start making little necklaces to sell outside, the little wrist things, I don't care what you got to do. But you have got to increase the amount of money that you can actually invest, because you will get minuscule returns that won't actually move the needle. All right. It's important that the income is high enough to where you can actually allocate enough money to investments to actually materialize a return. Okay. Now, let me tell you what I see personally happening over the many, many years of working with people. What I see is this. When the market is doing really, really well, like it is doing right now, this is what I've seen people historically do. And they don't wait until the market's sour. They don't wait until the market goes down. They don't wait until it drops precipitously. What they do is this. They sell. They sell out of positions in the market, and they go buy real estate. They go buy a home. I've been seeing this almost like clockwork. Every single year we have a run-up like this. If you are a retail investor in particular, and you got, I don't know, 50, 150, 200 to $400,000 invested in the market, right? I'm just going to use those arbitrary numbers because that's a more of a probability of what retail investors will be dealing with, right? They made their money. They cash out. They cash out. They don't keep waiting for Meta to go up. They don't keep waiting for Nvidia to continue to go up. They cash out. And they take that surplus, that 300,000, that 250,000, that 180,000, they take it out of the markets and they go buy real estate. Now, I've been seeing it, and I'm like, why do they do this? I understand it, but I'm like, man, the upside is still too great. But you can never time it. You can never maximize what you get and then get out before it all goes bad. Because everybody believes there is the downside going to eventually come. All right. Warren Buffett is sitting on, or Berkshire Hathaway is sitting on roughly about $350 billion in cash, and cash and short-term interest, meaning treasuries typically, right? So they keep it in short-term interest where it's very liquid. They can easily assess it, right? About $300 billion, which is the most money I've ever seen them sit on for this period of time. Some people use him as an indicator of what's been going on. Some people rather be early than late, but that's what I have historically seen over the years. Regular people like us, people that have $4 grand, $5 grand, 10 grand, 50 grand, 100 grand, $500,000, million, whatever, they get out and they get in real estate and they buy a home. Maybe they never had a home before, but they go buy one. And part of the reason that they do this, most of these people are typically in professions where they have some level of comfort in their career, where they know even if things go bad, I'm going to have a job. And I just need to maintain the home that I'm purchasing or whatever the case is now. And that's what they tend to do. Some of them get investment homes, but I see most of them buying personal property. And I'm talking to retail investors in particular. I'm not talking hedge funds. I'm not talking like big time investors. I'm talking regular people. They got 50 grand, 100 grand, 200 grand. They pull it out and they buy a home. And then they just grind it out. And then and by the way, they're doing this at historically high interest rates, right? So talking about people getting 5.5%, 6.5% interest rates. And I think it's crazy, but how they justify it is they focus on the payment, right? I'm not telling people what to do. I'm just telling you what I saw and what I know. They focus on the payment and they get out. They're not trying to wait around and see if they can get another 100 grand out of this. Like, no, I got enough where I can cash in, buy this home, and I want to deal with it from there because I don't know where these markets are going to be. I don't even know if the decisions I'm making were smart. I feel like I got lucked into this money. I was just picking stuff and all the markets went up, which I think a majority of people are experiencing that. Most people don't know what they're doing. Most people don't know why they picked it. They usually pick companies that somebody else did well in, or they heard something. And so they won. One company in particular is NVIDIA. People that got in NVIDIA when it was, I know somebody that got in when it was $40. Now, I know she didn't know what she was doing, all right? Because I know. But it just lucked into it and stuff like that happened. And when you run it up like that, from when it was $40 years ago before the split, yeah, you take that money and run. And that's a common thing that I've seen from people who don't have real skills when it comes to making investment decisions. They get out. They buy real estate. They sit on that home. And then if the markets and when the markets start to come back down to earth or they start getting in the dumpster, then they're willing to refinance if they want or find a way to pull out some equity in the home that they now control, and then they'll dive back into stocks. That is a consistent strategy I have seen just regular people do. It makes sense. It's actually probably the more proven method than I've seen other people do who just end up going with the roller coaster method. They go all the way up with the highs and they go down with the lows. Most people sell out. So you will see a heavy panic around the markets when people are close to retirement, you work with them, they start seeing their retirement accounts go down. I promise you, they will panic. Switching companies, they will cash out their retirement account. Oh, I went to a new company. I got my 401k. I just cashed it out. That is a common thing to people. So people make a lot of hasty decisions around this time of year, and we will continue to monitor that and see how it plays out. All right. So now let's get into BNPL, okay? Because this show is driven around BNPL, right? It's something we talked about years back, a long time ago when we was on the original Fight Club, okay? I broke this stuff down a long time ago, but now, years later, this was when basically the inception of this stuff. Now you're about to see this stuff play out at an even higher scale, okay? Maybe you guys heard of a company called Klarna. Maybe you guys have heard of a company called Klarna. If you haven't heard of them, don't worry. You're going to hear from their CEO today, okay? It's important. Pay attention. Learn something. The CEO is going to break down, based upon the information, the data that they've been able to accumulate, and what they believe the consumers are actually doing, right? This is how we learn. So this is what we want to listen to. This is how we get some insight, okay? Now, we all can't be CEOs, but we all can be the investor.
It's less than 2 weeks right now until Christmas. So our next guest runs the buy now, pay later platform Klarna, and he's seeing holiday shopping up 26% from last year. Joining us right now to talk about the consumer, Sebastian Szymankoski. He is the CEO of Klarna. Good morning to you. So things are up in a big way.
Okay.
Can you segment it for us so we can try to understand where the growth is coming from, and also maybe if there's any slowdown, where that's happening?
Yeah, I think that the one thing that's misunderstood in general is people look a lot at the revenue, like the general sales number in dollars. But what people are missing is that due to inflation, the number of products, items sold is actually many times smaller. And so if you talk to a lot of the retailers that we speak to and so forth, their concern is, yes, the dollar value is the same, but due to inflation, the number of items shipped is less.
Have the kinds of products and the price point of the products shifted for you? Meaning the buy now, pay later sort of model was originated with higher priced items, but it feels like it's coming down in terms of price for that. And I wonder whether that's a good thing or a bad thing for the economy writ large.
It's a good thing for Klarna. So I have no idea what he's going to say, but most of them are going to talk around it. Yeah, he got them glasses on. He got them glasses on. Pay attention, which means he's probably really sharp. Now, the indication is the original creation of the buy now, pay later concept was items that might have cost a little too much, and you can break it down into multiple installment payments, but in a fintechy fun kind of way, right? Or so you believe. But when you hear him say, oh, has it shifted to now smaller items? What that means is if they have shifted from bigger items to smaller items, it is alarming. It is alarming, and it is a huge problem for the everyday person and everyday consumer, because what it tells me is this this tool now becomes an everyday use tool, and that is dangerous. It went from being, oh, I'll buy something that's kind of expensive. I'll be able to pay it off later. I really want it though, because I might need to get it now, but I have to pay it in installments. To, oh, I can spend, oh, I got this $20 bill, but I can break to $5. Or, oh, this thing costs $100. Oh, I could just break that down later. It starts to change the expense of consumption to an everyday process to where you don't recognize the difference. And you now see the financial tool as an everyday use item. And that is extremely dangerous.
It's a good question. I think, we saw that we estimate the buy now, pay later grew about 24% this year over last year in the Christmas sales. And I saw recently that some of the credit card companies posted maybe 2% or 10% growth at most. So what you're seeing is a clear shift away from credit cards, which makes a lot of sense. I think it's kind of, I think it was very interesting. Clear card companies posted maybe 2% or 10% growth at most. So what you're seeing is a clear shift away from credit cards, which makes a lot of sense. I think it's kind of, I think
now that's a huge assertion. That is a huge assertion. Did you guys hear him? He said, you're seeing a clear shift away from credit cards. A clear shift away from credit cards? You're going to have to back that up, player.
it was very interesting. President Trump announced that like one regulation he was actually for was interest rate cap at credit cards. I mean, we have $1.3 trillion of credit card debt in this country. And Klarna, with our services, have saved consumers over $2 billion in interest rate by interest-free payments. So this is an area where there's tremendous opportunity.
Well, interest-free if you pay on time.
Correct.
Right. It's very expensive.
Hey, look, hey, you saw that, right? Hey, you saw that. He got that big old smirk on his face. We saved our customers billions of dollars because what's going on with the other large financial institution, or as I would identify them as, the old traditional methods, okay? Pay attention. This old traditional methods. This is the new guy. This is the new hot people on the block. And then when the guy hit him with the, if you pay on time, and he goes, correct. Because he know if you pay late, we hitting them up with them late fees. Oh, yeah, you're going to get hit. And I know you're going to get hit because companies like Klarna actually need to make as much money on late fees and things like that because they take a huge risk by having such low rates and things like that. They need to generate the money somehow in risk versus reward. So, yeah, you better acknowledge that if they pay on time, player.
Well, there's tremendous opportunity.
Well, interest-free if you pay on time.
Correct.
Right. It's very expensive if you don't.
Well, that's not entirely true. I would say our late fees and so forth are on par with others. But again, if you compare it to a credit card, this is actually.
Now, this right here is a list of all of the people that utilize their services. Okay, so these are clients that offer you an ability to use Klarna. So we have Airbnb, which sounds crazy to me. You telling me I can stay here at the Nun chilling at the Holiday Inn. So you telling me I can be at the Holiday Inn and I don't have to pay all for that night? I can break that Holiday Inn on multiple installment payments? Now Macy's, now that makes sense because, y'all like Macy's, IKEA. Girls don't know how to put no furniture together and stuff, so IKEA got to clip in stuff like that. Cool. Uber makes sense because it's so heavily used, and you can split ride shares and all that. H&M, I didn't even know they were still in business. I kind of like H&M though. Yeah, now Nike. Hey, Misty Blue, happy holidays. I miss Misty Blue. I'm glad she's here. Now, Nike is interesting to me because, as you know, we have some interest in that. Are y'all telling me y'all buying y'all Jordans with the buy now, pay later option? Is y'all buying J's and y'all not paying them off for a few months? Is this what y'all call holiday shopping? Something is up. Something is up. Y'all better not be buying them Michael Jordan sneakers and then only paying them off a few months later. Don't you do it. Don't you do it. Man, I didn't even know you could do that. You know what? I'm actually interested in going on the website and see if that's an option. I'm afraid to actually click the wrong button, but I'm really interested in knowing if that is a checkout option. If I put $150, well, man, if I get those phone posits cost like probably $250, $272. Yeah, them things hit. And I want to break it down into an installment payment. I have no idea you can do that. Oh my gosh. What's that other company? Is that Neiman Marcus? No, that's Saks Fifth. Okay, Saks Fifth. Oh, Expedia is the same thing as Airbnb. Okay, cool. That's interesting, guys. So the reason why if y'all sitting there using Klarna on Uber, that is insanity. You guys need help. This is sad.
Few real savings, right? It's $2 billion. So for us as a company, we even wanted to say, President Trump announced that he was going to invite acceleration of permits and licenses for anyone willing to invest $1 billion. Where we are willing to invest $1 billion in the US and take on the big banks if we can get faster acceleration of our bank license.
So what do you say you want?
Did you hear that? I want y'all to pay attention to key language, right? And I'm going to break this down. We got 40 minutes. I'm going to tie it all together. He identified we are willing to invest in the United States. I believe Klarna might be a Swedish company, right? I don't recommend outside the United States investing because of the complexities of other countries, their laws, etc., and you don't have access to the high-priced lawyers and knowledge of their laws and rules and things like that. But it doesn't mean it's impossible to do. But Klarna could come in and invest in the United States. And you heard him what he say, compete with large financial institutions, aka the big banks. Now that's key. We'll come back into that later.
You want to be a bank. You want a bank license.
We are a bank in Europe. We
Right.
want to get a bank license in the US. We want to accelerate our money transmitting licenses, and we're willing to commit $1 billion to do that, to go after these horrendous credit card fees that American consumers are paying.
Now listen, everybody want to be you heard him? We are a bank here, but we want to be a bank too. It's hard to be a bank out here. It's not easy. It's a lot of regulations, restrictions, licensing that you need to get done. A lot of companies have tried. It's a very difficult business to operate. But you see, they want in on it. Why? What is it you want? Y'all want access to those depositories, okay? The thing that separates the banks and everybody else is they are somewhere you can store money and have it protected by the federal government. Ain't nobody else can do that. The PayPals and them can't do that. They have to partner with banks in order to get it done. And that's why they're trying to get past that little green tape. But now regulation from the CFPB are starting to come down heavy on these fintech companies.
We keep actually talking about the credit card sort of ecosystem and the future of it. Actually, in the context oftentimes about crypto, we talk about sort of how that, and stable coins and how it may bring down the prices of these fees. How do you think about that, and where do you play in that?
So we've looked at crypto. I mean, I think so far it's an interesting asset class that a lot of people have been interested in. It hasn't yet proven to be a more efficient way of transferring money per se between two different it's slow. It's not necessarily fast. There's improvements to it yet. And we're very open, and we are right now investigating if there's better opportunities to use it. We're seeing more and more people.
Long term, would you I hate to ask it. It's sort of like asking the big competitor. Would you short the credit card, the big credit card players, because of the margin they've been able to capture all these years? Does that margin disappear?
It will definitely disappear. The future with AI and everything is we're going to have digital financial assistants, agents that can go and negotiate on your behalf with banks. Today, this is a excess profit market. It's not a well-functioning market because we are too lazy as consumers to switch between banks. We're stuck with them. So if we can get AI agents to help us switch, what's going to happen is you're going to wake up in the morning and your computer will say, hey, I managed to get you a much better interest rate. The only thing you need to do is say yes. So
now, he's right about that. He is 100% right. He's sharp. He's well-spoken. He knows his information. He's not wrong about that. People don't tend to switch banks. If I asked y'all right now, y'all don't have to tell me which bank y'all with, but I want to know how long you've been with them. So in the comment section, tell me how long you've been at your institution, okay? Just say, it was 8 years, 10 years, 15 years since you became 18, your longest outstanding credit card. When's the last time you switched? You see what I'm saying? Like most times you get into their ecosystem, they never let you leave. We are too lazy to uproot our financial placement and move to another company, okay? People don't do it. It's a way. That's why they don't really offer things for existing customers. They always offer things for new customers. They're like, all right, if you're a new customer, we have this offer. And then the existing customer says, hey, I've been with you guys for longer. Do you have an offer for me? No. This is for new clients only because they know you're not going to leave. They know you have your automatic payments. And this is why it's so important. You guys have to understand this is the reason why they want to give y'all those cards. Not only do they want the data, they want you to set up your automatic payments, right? I don't have automatic payments. I personally, every time, make my manual payments, right? because it allows me not to be lazy and to be consistent on the things that I do. There's nothing wrong with automatic payments, by the way. Some people's life is better structured for it, that they set up automatic things. It makes their life simpler and easier. For me, in the way my brain works, it doesn't work well for me. I want to be able to personally process it, right? Now, I have to select a particular day when I have to get all of that executed, and I have to allocate time for that. But I'm willing to do that. I'm willing to miss out on something where people would have their time freed up so that I am still on top of the things I need to be on. So he's 100% right about that. People are too lazy to switch. Look, one of my people, 23 years, 09. See, that sounds like y'all not leaving no time soon, even though y'all probably got irritated before. So he's right about that. There has been some CFPB has been saying they want to make it easier for consumers to switch banks. There's been, remember, we covered that a couple weeks back. So that is very interesting. Music Man, everything I actually go in and I get it processed, sir. Now here's the thing. You don't need to do that. You don't need to do that, sir, okay? Because it is a lot of work, and you have to have a very, very good system so that you're not late on things. And the only thing that matters you not being late is really your credit card. If you're late on a utility bill, you pay a day or two later. They're not going to turn your lights off or anything like that. But I'm just saying, it's a way that I stay on top of things. I don't tend to allow for a lot of automatic things to be done. I like to be aware of things, but there's nothing wrong with automatic things. But the point being is, when you have a debit card or a credit card and you set up automatic payments from your gym, your cell phone, all of these, Netflix, Disney Plus, all of these things, when you go to leave, you be like, man, I gotta reset up these automatic payments again. I'm telling you, I had these conversations all the time. You got to do this stuff. They don't want to do it, even though that company pissed you off. So that is how they control that. So he's 100% right about people are lazy.
Of course you will switch. How should the investor class and how should even the consumer class think about you and, for example, a firm?
I think that what we are is a part of that change to retail banking. There's going to be a tremendous pressure on the excess profits that banks have shown. I think it's a $200 billion of interest rate that consumers pay on annual in the US. It's tremendous amounts of money that they are losing out on this.
But do you feel there's more competition coming into your space, Apple and others?
Yep.
There is, but it's a good thing. Look, I'm coming from Europe, where interchange is regulated, where credit card and debit fees transactions cost 20, 40 basis points. $100 charge on a credit card in the US generates 550 basis points of fees, both on the merchant fees and on the consumer side by revolving. That's a tremendous amount of money, which hasn't had enough competition, and it's going to come down.
Long term, do you expect people to use the buy now, pay later for everyday items? Is that happening? Is that and this goes back to, is that a good thing or not?
We talked about this.
Well, I think, look, when I was a kid, I used to work at Burger King.
Yeah.
And when people swiped the card, Burger King was the same in the US. You used to press 1 for debit, 2 for credit.
Right.
Now, I want to I want to highlight what he just did, but we need to move quick because we only got about 30-something minutes to get this done, and I want to get all this information out to you guys as much as possible. He just threw his charm in there. When I was a kid, I used to work at Burger King. That is a way to humanize himself with y'all, to make himself a likable individual, to connect with people that are viewing this so they can humanize them. Go, oh, word? Used to work a regular job like that too? You telling me you ain't live off of daddy's money? Most people don't do surface level. They stay on the surface level. They don't do deep diving research to find out if his family really, really came from money. But he's well-spoken, he's sharp, he knows the information, he's confident, and he throws that in there so he has a more, like a relatable personality that you can connect with. That was strategic, and you wouldn't even notice it unless you stopped to hear it. So that's why he brought up this Burger King, and then he's going to tie it to his, like I told you, his anecdotal experience, which is perfectly acceptable because he now can use that to effectively run a company and things like that. But that's what just happened for anybody that didn't catch it.
Is that a good thing or not?
Well, I think, look, when I was a kid, I used to work at Burger King.
Yeah.
And when people swiped the card, Burger King was the same in the US. You used to press 1 for debit, 2 for credit.
Right.
The banks removed that because as a consequence, we didn't put all of our spending which took only a part of our spending, and then we were less likely to revolve, and they made less money in interest. So what we are doing is bringing that back. Every time you press the Klarna button, there's a one pay now, which is the full amount. Actually, 30% of our payments volume is pay the full amount, debit, and then 70% is credit. And so giving people that option back gives them control over their spending. And then for the credit side, you only do fixed installments, you take zero interest, and you ask people to, because revolving is a bad concept. It's bad for consumers.
We had Max Levchin from Affirm.
Quickly, I want to say, he just said revolving credit is bad for consumers. That was his statement. It's quite a powerful statement to make. The name that she just mentioned, what she say?
People to, because revolving is a bad concept. It's bad for consumers.
We had Max Levchin from Affirm on recently, and he talked about how he's not seeing any slowdown in his consumer. The consumers are building, and the economy looks pretty great from what he's seeing with them. Are you seeing the same? And do you have the same consumer as Affirm?
We definitely see that people are using our products, and I think US is doing better than Europe. We have a lot of big business in Europe as well. Obviously, I mean, we have almost 100 million users worldwide. So
now, do not fall away from that statement. He's saying this is a foreign company, by the way. He's saying their business is better in the United States than it is in their headquarters business, to say the least, right? Meaning, people in Europe are not as quick as the people in the United States to jump on credit. That's his indication. Those people's behaviors out in Europe are vastly different from the people in the United States, or at least not at the rate at which the people in the United States operate. We are so conditioned, and it's an everyday item for us to use this credit compared to what's going on in Europe. And that's what he's indicating. That's why he wants to make investment in the United States. That's why it's fair for our leadership to go, these countries need to pay their fair share, because he understands that, and they see us as the biggest opportunity. And they're taking our money, reinvesting it in their country, and getting rich. So because of that, you guys just need to be aware of what's going on. This is targeting the American consumer.
we see both markets. And it's clear that US is doing better.
Clear.
But at the same point of time, we're also seeing this major shift away from credit cards towards buy now, pay later. So I think both for me and Max, some of that improvements are just because buy now, pay later is doing so well on behalf of other products.
But it's a younger demographic.
Yep. Partially younger demographic. We see about, our average age is about 34. So it's not like it's 18 years old. It's, about.
That's young, sir. That's young. Don't try to talk around it. 34, they just start getting some money. What besides these YouTubers, these social media people, and that one girl that was on the fans, besides her making $5 million a month, most people ain't got no money yet. Okay, money got to be built up. People got to get a better career. This is in the third. Those are young people, sir. Nice try, but the behavior, she is right. I do not see older clients typically wanting to use this product. These are typically younger clients, and I'm going to say something. Typically, there's a certain client that use these products more than the other clients.
But it's definitely a generation that's, McKinsey did a survey in 2015. They called them self-aware avoiders. These were the audience, about 20% of Americans who are tired of the dirty tricks of the banks, of how they promote limits and so forth. And they want an alternative. They want fixed installments, transparent fees, easy to use.
I can't say that he's wrong when it comes to, I wouldn't say dirty tactics. I disagree with that. That's uninformed people being emotional because they're upset, because they're uninformed. But definitely people do want installments. They do want installments. It's similar to like a mortgage, right? You want that consistent rate. You don't want an arm. You don't want an adjustable rate. You want to know exactly what that payment going to be and leave me alone. So I understand his statement on the installment aspect of it. So I definitely don't necessarily disagree with that. Let me see here. I want to get into this real quick. All right, yeah, we're going to have to speed this up a little bit.
Now Pay Later continues to gain some popularity. It's expected to account for $18.5 billion in spending this holiday season, 2024.
So I want you guys to pay attention already from the jump, okay? So $18 billion will be attributed to buy now, pay later spending. $18 billion.
according to Adobe Analytics. Here with some insight into current buy now, pay later trends is Kevin King. He's the Vice President of Credit Risk at LexisNexis Risk Solutions. Great to have you here with us. And so, as we're just evaluating some of these stats and the spending here, what does this really hold for the mentality of the consumer from your own read through right now?
Well, that's a good question. I think it's the answer is that maybe changing the way consumers are thinking about credit, right? Because it's creating more affordable rates and terms for individual retail purchases. But I think Matt just made a really good point a moment ago. Also something that may be doing some harm in terms of encouraging unsustainable purchasing habits.
Yep.
And allowing consumers, if they're not managing how they use these loans carefully, to get in over their head very quickly.
And so how do you expect that, especially coming off of a holiday season where consumers have already been regarded by many of the retailers as looking for promotions, looking for discounts, and ultimately looking to perhaps put some of their rewards into play as well? When we get into next year, where buy now, pay later could either take a back seat, or ultimately you look at a consumer that says, I just don't need to tap into this experience as much anymore because I am being more judicious about my spending.
We see actually maybe a different set of behaviors, Brad, already into the holiday season. LexisNexis Risk Solutions monitored this past November relative to November 2023. We saw a 20% increase in buy now, pay later use. And that increase really started spiking maybe a week or two earlier than Black Friday and kind of that traditional kickoff of the retail season.
Now, if you hear about a spike of 15 to 20% prior to what normally has gone on for the Black Fridays and things like that, that is an indication that they are getting more comfortable using these as more of a daily use than a one-time purchase of a higher or more expensive item. They're getting it closer to using for everyday costs. Dangerous.
And that growth, Brad, according to our research, is not driven by new consumers who are trying this out for the first time. 94% of those buy now, pay later loans came from existing customers that already used the service, but wanted to find more and more ways to leverage that financial tool. So I don't know if I see the appeal broadening, but it's clear that once consumers develop an affinity and a familiarity with these tools, they're using them again and again, retail season or not.
So in short, there is an issue with acquisition of customer, according to him, right? So they're not growing the customer base year over year, meaning exponentially, where they're getting new clients. What they're saying is, once you use the product once or twice, you understand how easy it is to use. You go, oh, click this button, check out here. Oh, I can use it for this. And now it becomes a behavioral thing where it's a normal process for you. And so the people that only used it once before, they're starting to use it again and use it again and use it again. And that's why you have a return. That's why people are willing to give you discounts. That's why people are willing to say, oh, for your first purchase, we're going to give you this off, or we're going to give you this, because they just want you to try it. They just want you in their ecosystem. Once you get in there, gotcha. Like Dave Chappelle said, gotcha. They know they gotcha, and you're in the system. So these are not even new clients. 6% is new, basically, what the indication is. These are people that have used the product, and they're going to use it again and use it again. And that tells us that it's might be slowing in user increasing, the end user getting more of them. But as far as active users or people already in the system, they're using it even more.
Further entrenchment among an existing user base is something that you're tracking, it sounds like. So with that in mind, has the type of purchase that people are expanding their use of buy now, pay later for, has that changed materially, or is it the same type of classification or product that you're noticing right now?
Now, mind you, this is the same question that was posed to the Klarna CEO in the other interview. They answer them slightly differently.
A great question. And I would say it's changing materially. If we cast our minds back to maybe 2020, when buy now, pay later use in the US was kind of first entering our consciousness, we thought of this as a tool that was being used to finance home gym equipment, right? Luxury retail goods. And that's still part of the story. But we're seeing more and more consumers use these tools for essential goods like groceries. 18 and 19% of transactions in 2023 started to skew there. And essential services like auto repair, for example, is something that's becoming increasingly leveraged by buy now, pay later users.
So with that in mind here, and this might be coming a little bit back to...
The man said groceries. Did you guys hear him? He said it's accelerating. The way in which they've used this product in the past, the shift is accelerating, meaning there's a connection point for both of these representatives. They both have identified, what they used to use it for, the big purchases, the one-offs, now they're using it for everyday things. It's starting to become a normal process for them. You are now part of the system. Groceries, how can you buy now, pay later for groceries? Are those food stamps? What is this? What is the minimum purchase for buying? Like, this is crazy. This is not good. This is not good. This is not good.
To the question that we had brought up in our previous conversation, and to start off our conversation a little bit, what does that actually mean that the health of the consumer sits at right now? I mean, we're going to get a data print this week, and CPI will get retail sales as well next week, and the Fed's really going to have to put together their own assessment among the health and really try to encapsulate the health of the consumer going into 2025. What does that look like from your own assessment if you do have this many consumers that are using BNPL for even groceries right now?
You know, there are areas of buy now, pay later use, which I think can be actually very responsible for some consumers. It'll be interesting to see how some of those bodies view it, right? Generally, we're talking about lower interest rate loans. If you're a parent who's buying an expensive gift for their kid for the holidays, if your only alternative was maybe a subprime loan, well, this is maybe a really big win. Even some of those APRs Matt covered with retail cards, we're talking about things that are much, much lower. The key is, are you using this to finance 1, 2, 3 purchases a month, and you're tightly tracking each one of those loans?
Look. Now, this is so interesting. Look at the benefits. Lower interest rates, lower missed payment fees. I want you to pay attention to that. Lower interest rates, meaning historically what you'll get at the traditional, this is how you distinguish fintech, traditional. Traditional banks, I'll break that down in the next segment. But traditional banks, what they offer versus what the fintech companies are willing to offer is going to make sense in just a moment. I'm going to tie it all together.
When they're going to take the money out of your checking account, or you start getting addicted to the experience of easy access to credit, and you get yourself in over your head. We know consumer household debt is on the rise. We know delinquencies are on the rise. It's going to be interesting to see how this user base starts handling subsequent or concurrent, maybe buy now, pay later loans. Can they manage that burden, or do we start seeing it further accelerate the pace of delinquencies in the U.S.?
Just lastly, while we have you here, Kevin, just want to give people some actionable advice here as they're doing some of that shopping this holiday season. What is the decision tree for safe buy now, pay later actions that consumers may be taking?
Yeah, really, really good question, Brad. I would say this. If you have a couple of large purchases, and that could be essential purchase or it could be retail, that you would have made with your normal credit tools that might be easier to handle broken up into a couple of installments, buy now, pay later makes sense, but you need to track exactly when those payments are going to get taken out of your checking account, who you've taken out the loans with, and you're overall keeping an eye on the total debt amount so you don't get out of control.
Now, I want you to pay attention that he says your checking account, because the reason why this is important is you still got to deal with those banks. They still got to deal with those banks. And shout out to the lovely Jay Ali in the building, gifted 1 membership to the gang that she's already a part of. So once again, thank you to the lovely J. Ali. Okay, she's had my back the longest. I trust her more than I trust all the rest of you, especially Jabba, because you over here causing trouble, sir. I feel like you trying to give me some bad luck, sir. Nobody in our community says best of luck. I hope you do well. It sounds like you trying to jinx me, my friend. That's what it feels like. You're trying to jinx me, my friend. You're making me nervous. You're making me nervous. Feels like you're trying to jinx me, my friend. You're going to have to clean this up. And what you're supposed to say is y'all going to dominate and y'all for sure going to win. But I can't trust you now because now I see your angle, okay? You're trying to find a way to laugh at my misery, okay? I see what you're doing. I see what you're doing. We ain't going to let you do it to us. You must be one of those Steelers fans that just looking to give me a hurtings. You're looking to give me a hurtings on my own show. On my own show. Can't believe you do this to me. I don't trust him, y'all. I would time him out, but I can't. Can't do it. Can't do it, okay? He is a member, okay? Now, I have to tie these things in, okay? I got a few minutes to get this done. This is important. They talked about traditional costs, late payment fees, and interest rates, right? This is why this is very important. And you notice at the end, he says, when the money's going to come out of your bank account, which means you ain't getting away from the banks. This is important, okay? Okay, you're right. Change my mind. Somebody time them out. 10-second timeout. Yep, put them in timeout for 10 seconds. Yep, we not having it. We not having it, okay? All right, so let me tie this all together for you guys and get this done for y'all, okay? Let me tie it together for y'all. Let me pull this up here. Okay, I got it. I got this. Now the fun arises, okay? The fun arises. The biggest company that I know in the U.S. is a firm that does this buy now, pay laters. Obviously, I talked about Max earlier. Anybody that knows Max, can't say his last name unless you hear them say it. He comes from the whole PayPal mafia, okay? The original crews, all of them are doing really, really well. All of them are making a lot of money, all of them basically billionaires. He's taken his money and he's shifted it to a firm, and this is how he's going to build up his empire, okay? He is sharp. He is really, really smart. He is extremely strategic. If you ever looked into him, you realize this is the type of CEO you would want running your company. He is very aggressive. He's willing to take risks, and he typically wins big, all right? But this is a new industry that he's helped carve the way for in this fintechy type of technology. And this is important because he's gone and done something that is very important.
Breaking news just out right now from Buy Now, Pay Later company Affirm. Leslie Picker is here. She joins us now with more.
Hey, Becky, good morning. Two trendy areas in finance, fintech and private credit, coming together in a new multi-billion-dollar joint venture. Affirm just announcing its largest ever capital commitment with a new partnership with private credit firm Sixth Street, which is investing in $4 billion worth of loans over the course of 3 years. Sixth Street will commit capital upfront for Affirm to underwrite short-term installment loans. These are between 4 to 6 month timeframes. Once paid back, the capital rolls into a pot to make more loans, which amounts to more than $20 billion that Affirm could extend over the life.
Now, this is very important. I want to tie all this together for y'all. We have been learning on YouTube very much about credit card rewards and credit. We know where they getting us at, and we have become more knowledgeable. Now, the one thing I tell y'all is this. Once you learn the game, they change the game. And now what you're seeing is they are shifting the game to buy now, pay laters. So when the CEO from Klarna was saying and the other analyst was saying this type of behavior are looking like they're leaning towards not eliminating, but going away from credit cards. I believe it's true. I don't know if they'll be able to finish the deal, but they definitely started a movement, okay? And what this means is that the old traditional banks, and this deal will kind of make you understand because Sixth Street is one of these companies that work with all of these banks on strategies and things like that. These traditional banks, they underwrite, but they only underwrite in the way in which they know how, because their risks comes from what they understand, and they use proven methods, because when you switch methods, it makes investors uncomfortable. Oh, you switching away from the business model? You changing it up? Hey, I don't know if my money's safe with y'all. I don't know about that. So now all of the fintech companies that switched over and started taking all these risks and all, because most banks, they are not willing to take as much risk as y'all might think they are. That's why they tell you, oh, no bank gonna give you no loan for that. They ain't about to give you no credit card. They are very stingy with credit. It is not that easy to get. They'll give you a secured card of your own money on the line, but they are very stingy. So what the fintech companies did, and this is important as well, I want y'all to learn overall about this. They went out and took the risk to study the new consumer and help the trend and the changing consumer behaviors. And so what they did was they went out and did short-term installment loans, lower fees, lower interest rates, things that traditionally could not be given, because in order for them to take risks, they have to charge you this interest rate. If we're going to take this risk, historically, this is what we need to do to make sure we stay in the green, right? We want to make sure we're clear. So these fees, we need to cover for the 17 delinquent cards. This one fee will cover those 17 delinquent cards from this one customer. And that's how their strategies tends to work. So now the fintech companies have studied the new consumer as far as the buy now, pay later habits. They're getting them comfortable. They're using technology. They're getting their behaviors down. They're getting them in their ecosystem, and then they underwrite. So the traditional banks don't do well with underwriting these short-term installment loans as these newer companies tend to do, because they have the data. They have the information. They have the better strategies. They are more prepared, because these old dinosaurs, they've been kicking their feet up and just been collecting their dollars the comfortable and consistent way, but they haven't shifted with the new consumers. However, this is what they've done. You still can't get rid of that old dog that got money. So what they've done is, look, we're going to give y'all the money. Y'all know how to underwrite better than us, but y'all don't have the capital flexibility that we do. We can burn some money. So if you do run off on the bag with us, that's cool. We still got enough money. So we can afford to lose money because we have enough customers bringing in money. The buy now, pay later companies do not have that flexibility. They don't have the liquidity to take those L's and things like that. They need it. So they had to get an influx of money so that the strategies that they've learned, even though they do really, really well with them, they're still at high risk. So the private banks and all that said, hey, we know we're a little old school traditional and y'all got the new juice. We're going to give y'all some money so we can get in on this money that y'all about to get off the new changing consumer behaviors. So all that's going to happen is you're going to see more partnerships. You're going to see the older banks and stuff like that just tie up partnerships because they have the money to actually endure a long-term strategy instead of dealing with the short-term strategy that these companies have to deal with. So that's what you guys are seeing actually occur right now. That's what you see happening right now. And it gives the credibility that these strategies will become long-term. And if you were listening to the interviews, right, because I'm not doing this for fun, okay? I'm doing this for people to actually learn and for us to learn together. You heard them say things like, oh, they're using this for everyday purchases now. They're shifting at an enormous rate. They're using for groceries, to fix a car part. Like, it's starting to become a normal everyday process. And once they get you, so basically it's this. Y'all learned the old game. We still going to play this game with y'all, but we're going to switch the board game. So instead of playing tic-tac-toe, we're going to play another game, and we'll call it something else. I don't care what you call it, but it's the same game. We just switched the arena. So this is still interest rates. There's still penalties. It's just we're lowering the fee amount because we found out that we don't have to charge them as much as these big banks did. This actually works best, and we make just enough to survive. This will work. And so they look better than the big banks do to people who haven't got the ability to go deal with them. So now they're like, okay, lower interest rate. We're not really going to ding you for that. And it's a installment loan in a lot of the cases. So what that does is people are more comfortable when they know exactly what their payment is going to be. you don't really know exactly what your payment is going to be on your credit card or revolving loan, because if you buy something else within your credit cycle, well, that payment may be different. So you don't know if the payment is going to be $57, $60, $68, $42. You just know you got to pay something whenever you get that payment cost in, or what do they call it, the ticket or voucher, whatever they call it. When it comes in and you see how much you need to pay, that's the only time that you do. And so they've moved that away and said, okay, we know that the customers respond when they know exactly what they have to pay. And even though we know that they're going to sometimes forget, we're going to make enough money on the fees here and then the sometimes late people here. So they just switched the game up. They just 100% switched the game up a little bit. I do not expect this to effectively eliminate credit cards, because the protections that exist with credit cards, they're trying to fight what buy now, pay later effectively is, and is it actually a credit card, and should it have the same protections and all these things. Eventually, I believe they all will most likely have some similarities there, but we're going to watch this play out over time. It is scary that y'all buying groceries with this, but it looks like this is going to be part of y'all everyday thing, because when you can just click a button and say put 70% on credit and put 30% on debit, and all these things that they used to do, like he said, the banks used to offer this. They found that they were losing interest and they took the option away. All they doing is bringing back old option and repackaging it and calling it something different. The key today is this: know the game, know that they playing the game, and know that we in the game. So don't try to be on the sidelines. Be in the game to play, okay? Because when you're in the game to play, you learn, you compete. Everything that we do is to find out where they're trying to attack us at. That's the first way you get on the offense. Where is our defense? Now we know the game y'all playing. Now we can set up a strategy to combat it, okay? I don't know what y'all going to do with this. I don't know if y'all going to get down with the buy now, pay laters. It's totally up to you. But I recommend you learn your habits, put the best strategies forward. I never use the buy now, pay later. I don't expect that I ever will need to, but if I did, I understand the strategy in which they use to pull at my tendencies. They know how to market to me. I'm just aware that they're marketing to me. So it allows me to combat them in a lot of ways. But the point of this is it's the same game, y'all. It's the same game. They just switched the arena. So they don't call it credit card. They call it buy now, pay laters. All they want you to do is realize it's the same thing with mortgages. Hey, here go the payment. Even though you getting killed, and I mean killed on interest over 30 years, you paying double the cost of the property or whatever the case is, sometimes triple in a lot of cases. It's that knowing what the payment is that brings people comfort. Tell me that's why they say, how much is my payment? If you ever find yourself running down the rabbit hole and you're saying, well, just tell me how much the payment is, just know they got you right where they want you. The second you say, yeah, what's my payment going to be? They got you right where they want you, because they know that your comfort is in knowing what that payment is going to be. And that's how they get their money off you, okay? So, ladies and gentlemen, I hope you guys enjoyed the show today. We have reached a conclusion. You guys, just in time, we right on the money. Jabba the Hater was in the building. That's my guy. But it's going to be Eagles Nation all day, okay? I'm actually not going to be able to watch the game because I have other things that I have to attend to, and I can't cancel, unfortunately, because I can't tell these people, hey, you know, the game's coming on, and the game's more important than y'all. That ain't going to work, sir. So I'm eternally going to be crying while I'm unable to watch the game, okay? Oh, but I need all the support. Hope you guys enjoyed the show. Please do me a favor, leave a like, dislike, I don't care. Leave a comment after the show if you want to discuss something in particular, things you want me to cover, things you want to look into, conversations you want to have, anything that y'all want. That is the goal of the conversation. Shout out to my brother Shine Antonio in the building. We gonna get up out of here. Enjoy y'all day. I see you.